All right, so we're just going to start rolling through these examples. A lot of them are simple, but part one is, once again, I'm following the different processes. So we're going to start with capitalization. And capitalization, another general term, it's the process of recording a long-term asset. There was a little lag with the pen there. Asset, okay? So, we capitalize equipment, we capitalize receivables, we capitalize lots of different things, but it's so here we're just talking about intangibles. Once again, intangibles are located as typically as long-term assets. If you're in the last year of a patent, it would be moved to current, but in general, we're talking about long-term assets here. Okay, so the first thing we're going to capitalize is any purchase intangible. So this is just like equipment. If you buy it from another party, you recognize the intangible asset at its cost. So in this example, they buy a drug patent from Birdie buys the drug patent from a research company, and they record the acquisition of the patent. They bought it for 25 million, patent, cash. That's it. So nothing really new to learn here except that you do capitalize it when it's purchased for intangibles, all right? Now, internally created intangibles are not recorded. There is an exception for software development costs. So we're not really so focused on that exception, just pointing out that it's out there. But if you hire an army of research scientists and you give them a space and you give them supplies and all of that will be expensed as incurred. Okay, so what does that mean? Well, the salaries are periodic expenses. If you buy a building and you depreciate it, the depreciation is R&D expense, is moved to R&D expense. Let's say if you buy some supplies, those are expensed as used. So you follow your normal expensing rules. Just because it's R&D on a building for a research building, you don't expense the building all at once. You follow all the rules you've always followed. It's just now they're going to be moved to research and development expense to tell the user of the financial statement, hey, this particular expense is being used in research and development. Okay. So in the example 2, they spent $2 million in research costs and the drug is actually patented. So it's not like they did some research and they don't even have a patent to show for it, but they believe there's value. There's an actual patent. The legal costs associated with obtaining the patent were $50,000. Record the intangible. Only the legal and other costs to secure the patent are capitalized. The $2 million is going to be R&D expense. So you'd have R&D expense debit, and then you'd have whatever, salaries payable or salary paid and depreciation, all that other stuff, accumulated depreciation, all that other stuff would be the credit. Okay, so what for intangibles, other than goodwill, what are we doing? If you purchase it and you can record it, or if you have legal costs associated with it in either creating or defending it, those are capitalized as well. Okay, whether limited or indefinite life doesn't matter. It's the same capitalization process. Okay, now goodwill is a totally different type of asset. It only happens when one company buys another. So when one company buys another, the first thing to notice is all the assets and liabilities are initially recognized at fair value. So that means when one company buys another, the first thing they're doing is acting as if they're buying every asset individually and taking on every liability individually. So they're not recording the book value that the target company has. That is not relevant. What's relevant is the fair value of all the assets and all the liabilities as if they purchased every single asset and took on every liability on the date of acquisition. Now, the purchase price, which is almost always greater than the net asset value, is taken, you subtract the net asset value from the purchase price, and that is goodwill. Okay, so let's just look at the example. It might be a little clearer to see. So Birdie Pharmaceuticals, they paid $20 million to acquire 100%. What does that mean? 100% of their stock. They're taking over control 100% of the company. And here's the book and the fair value. Now, your textbook always seems to have one column, and we'll get to that later. But I think when we're first taking this on, it's a little easier to separate out. So this is as reported by Nova. Okay. And then this right here, this is called due diligence. So there are accountants that specialize in this. So these are valuation specialists. And they're going to find every identifiable asset specialist. They're going to find every identifiable asset, whether it's recorded on the balance sheet of Nova or not. For example, Nova had a patent, but since it was internally generated, it was valued at zero in their books. This is the whole reason they're buying the company, really. So when they buy it, they have to fair value the patent. They hire a valuation specialist, and they say it's $5 million. Okay. Now, cash to cash, $2 million. Accounts receivable, $3 million. Let me tell you, typically, those are going to be reduced. It's ugly out there in accounts receivable, but for this example, they're the same. Inventory, when we acquire it, we write it down by $1 million. Accounts payable, the liabilities typically are the same if they're with banks. If they're market value instruments like bonds, you may change them. Okay, but this is pretty typical. So now what we have is the fair value of assets and the fair value of liabilities. And the net fair value of assets equals 15 million. Okay, it's just 22 minus the 7. So think of it like this. If you owned Nova Research Incorporated, you could sell off all the assets, pay off all liabilities, and you're left with $15 million. I refer to that as a liquidation value. The book doesn't, but I do. I think it's more intuitive. They throw the word fair value around, and you need to know that. But sometimes, to be more clear, I'll say liquidation value. Okay, if you liquidate the company, what is left over? 15 million. Obviously, you're not going to sell for anything less than 15 million because you could always just liquidate the company and get 15 million. But there's a value to keeping the company together, which is the whole reason we have companies. You know, you have certain scientists perhaps with the company, you have other relationships, other access to capital or whatnot. Who knows what the values are, but there is some value to keeping the company together because otherwise they just could have bought the patent. Okay, so let's go look at the goodwill. So I said this is the liquidation value, 15 million. Goodwill is the purchase price or the fair value for the company as a whole, minus the liquidation value. So for some reason, the acquiring company thinks that if I keep this company together, it's worth another 5 million. Okay. Now, we're not questioning that once we get that number from, we might question, did you value it properly in terms of the due diligence or the fair value of the assets for an auditor? But generally, in terms of corporate accounting, they're going to give us, we got the purchase prices pretty clear, but they're going to give us a $15 million value, net fair value net assets. And we're just going to take this number. And what we're talking about is once you have the number, what you do with it. Well, we have 5 million of goodwill. How does it work? Well, you put on all the assets at fair value. You take on all the liabilities, and here's the purchase price. And if you didn't have this 5 million, there'd be debits wouldn't equal credits. So of course, if you're an accountant, not having debits equal credits would drive you crazy. So we had to create an account for it, and we call it goodwill. All right, so that is how we record the goodwill intangible asset. Okay. And we're going to have software development costs. I will say that this is, let me just say that know that it's an exception. There is an example here, and this is similar to IFRS for all intangibles. Under IFRS, any development costs incurred after technological feasibility, actually, they're required to be capitalized. Well, under under our FAS, they're not required. Under IFRS, they are required to be capitalized, regardless if it's software development cost or patents or anything. Okay. So you can take a look at it, but I'm not going to be too worried about software development costs. It's an exception to the general rule that R&D is expensed. Whenever you come into a situation under US GAAP, if it's not software development cost, you should assume R&D is expensed.